Hello, everybody. Welcome to our event today. I can see people showing up already. So we're going to give a couple of minutes to everyone to join. First of all, Gabriella, Gabby, Gabs. I'm from Cake. I'm the community manager at Cake. So I'm here in the beautiful Gold Coast to host you on this amazing event today. We're here with Paul, Olympia, Peter, and Jason. They are absolutely guns in the VC world and the startup world. So I'm sure you're going to learn a lot in this webinar today. We've got a lot of people registering. So if you guys could please drop in the chat where you're watching from. And obviously, if you want to share with us, if you're actually investor or you're a founder, and if you already raised a round, it would be really good for us to know who is watching and what we can cover for you today as well. So as I mentioned, I'll give you a couple of minutes and please, yes, feel free to be as much interactive as you can. We've got someone from Bondi Beach, which is amazing. I'm from Sydney, so pretty close to you. We've got Molly from Melbourne, really good as well. Cool. Sunshine Coast, Go Coast, Series A. As I mentioned, guys, feel free to share your round with us if you actually been through a round or not. We've got Olympia in Canberra. Cool. Melbourne.
Hey, Michael, one of our partners. Good to see you, mate. I think he's a Cake investor as well. Love you forever. Thanks, mate.
Cool.
Back in the day when we were hustling around our pre-seed round, every single one of those investors I'll remember.
Cool. Early stage of mental health tech startup. Really cool. Looking for a pre-seed to come. If you're joining just then, guys, I'm the community manager at Cake. We're just giving a couple of minutes for everyone to join. If you want to share with us in the chat where you're watching from, and also if you've been through any round, and also if you're a founder or investor with us today. And we are here with this amazing panel and super happy to have you all. And as I mentioned, guys, please throw questions in the Q&A or throw questions in the chat so we can actually have a really interactive webinar. We know that we probably have a lot of questions. VC, it's really tricky sometimes. So amazing to have you all here. Recently joined Investor Side from Adelaide. Cool. We've got an investor as well.
Hey, Gab.
Congrats.
Let's go and I guess just get Paul and Peter maybe to share their last three investments with the group, just to give us an interesting way to kick off. I guess we're all here to talk about funding, so let's see what the guys have been up to for the last couple of months.
100%. Let's go.
What do you reckon, Paul? You want to kick us off, mate? I might be one of those, actually. Or
sure.
Maybe it was Olympia. I'm not sure.
we are a very proud investor of Olympia. You've given a tight question of the last three. Goterra was not in our last three, but will be to come for the next round. Cake is certainly a recent investment of ours. The other couple we've done recently, Muso, Jig Space, and Mass Dynamics.
Oh, cool.
Awesome. Yeah, I know a few of those. Thanks, mate. How about you, Peter? You're up in Singapore, investing in Southeast Asia mainly, but a little bit in Australia as well. What about your last three, mate? What's going on there?
Yeah, I'll call out maybe the last two in the region and perhaps our last one in Australia. So we invested in a company called Redefining in Singapore. It's a blockchain company. It does certification and verification for education and health certs. Interestingly, it's doing all of the sort of COVID vaccine certification in Singapore.
Cool.
And expanding that.
You don't call that Web3, you call it blockchain. Is that a distinction, or where it's Web3, is it? I think a lot of people would call that Web3. I'm still trying to work it out legitimately. I'm not trying to hassle you.
You wanted to. You don't have to.
Okay, cool.
We're less fussed about the distinction then. Of course, the founders, the team, the product, and all the things that we're going to talk about coming up. That's one of our latest investments. Another recent investment is a company called Conversational. Conversational is a platform for community managers, mainly on Facebook at this point in time, to help them manage their community with a lot more fidelity, a lot more control, a lot more detail, and provide a much better experience. But it also enables them to monetize those communities as well, and give more sort of different types of promotions to those communities, and that's a company that is from both India and the US, and it's one of the, I think it's a sort of category defining company. It's kind of like the buffer, but sort of super buffer for Facebook communities. The latest Australian investment that we made probably was our recent top up in a company called Curious Thing. Curious Thing is a conversational AI company based in Sydney. Sam Jeng, who's the CEO and co-founder, is an ex-co-founder of Hypebrand. So that was our latest Australian investment.
Awesome. Yeah, I think I know one of their other investors. Their name came up recently. It might have been 1013. I can't remember who it was. Anyway, fantastic. Thanks, Peter. And Olympia, congratulations on the latest round. Do you want to share a bit about that round and your funding journey with the crew?
Yeah, it feels like a decade ago. So we've closed
founder years. We need like a new dog years. Founder years.
Yeah. Well, and now because we're raising the next round, I'm not sure, and it's with mostly US funds. I'm not sure what to call the last round, because it's technically the second round, but maybe it's a pre-seed or a seed or the angel friend seed, something. I can't ever remember which name to give it. We've raised twice, and now we're raising again. And we're a robotics company here in Canberra that manages food waste with maggots. So
sounds like you're changing the world. Good to hear. Yeah, we've raised 3 rounds. I don't like to name my rounds either, because it's confusing, but yeah, grateful to get Jason Calacanis and Launch and Rampersand leading our last round. It was a 3 million Aussie round, so excited about that. We're actually very close to raising again now, and obviously at Cake we work right across the ecosystem with all the VCs and accelerators and lawyers and staff. We coach capital raising constantly, so hopefully we can just ask some good questions today and share a few things. Our goal is to make sure you all learn a couple of really awesome things on this session to make your capital raising journey more successful. So that's our main goal, and we're going to be pretty conversational. So I ask everyone to jump in along the way on the panel, and let's challenge each other a little bit to make sure we're sharing the best information possible. Cool. So even though I've just said we're conversational, let's kick off with a question. So Paul, maybe from you, mate, I guess just a bit of a high level view. What is VC? How does VC work, and how, in your opinion, is it progressing in Australia?
What a big question. And I sort of think like there's, if you're an Inuit, an Eskimo you've got 37 words for snow. Like when you get into the detail, like there's real nuance between it. So there's not sort of one answer, and I think it depends on the stage and the structure. I think the things to sort of call out of what is a VC that are important for a founder to know. Typically, the first thing to know is that VCs have their own investors. So some VCs are backed by large super funds, or some are backed by a big corporate or multiple big corporates. Rampersand is backed by about 120 private individuals and family offices. And so the way that we work in general as a VC goes to investors and says, these are the kinds of things we're going to invest in. Here's why we think we're best placed to do it. And here's the kind of financial returns and the other value adds that we think will deliver over this kind of time frame. And that creates, two things. One is a mandate, and that mandate is sort of the box within which we invest. And we've made a promise to our investors that this is what we're going to do. And every fund has a mandate, and it might be very broad or it might be very narrow, but it is the guardrails upon which that they have made promises to their investors. And the other thing it does is sets sort of the size of the fund and the amount of investments they're going to make. And it also indicates things like how much money they're going to put into a first check and how much money they're going to reserve for follow-on. So some funds just have a mandate that says we'll invest in 20 companies and we'll make one investment in each company and we'll see how they go. Whereas other funds go, we're going to invest $1 million in the first investment, but we'll reserve $4 million for if the company continues to go well. So depending on sort of the stage that they focus, the mandate that they've got, and their investment practices dictates like what, so there's an expression about family offices. You met one family office, you've met one family office, like they're all different. To some extent, that's true with VCs as well. But what is in common? They've got investors, they've got a mandate, and they've got a time frame.
Yeah, what I love about that, and I think this is one of the best lessons founders can learn, is that the capital raising process is a matching process as much as it is anything else. And a big part of a founder's role is to try and find the investors with the mandate that matches what they're doing, and then ask the right questions. Ask, what is your mandate? What is your check size? Do you keep funds for follow-on investments? And understand all these things, including the process of the investor. You're going to have a much better time overall with your raise, and you're going to burn a less emotional energy. I think a lot of founders really burn a lot of emotional energy on no's and getting confused and not understanding the feedback correctly and taking it through that lens of each investor is trying to find something that matches their mandate and what they're trying to invest in. Paul, anything you'd like to? Sorry, Peter, anything you'd like to add on that, mate?
Yeah, I think maybe the other aspect to be mindful of is that most VC firms have specific funds. Those funds tend to be 10 years. So let's say you're an investor in one of those funds. The fund will have a fund term of 10 years. During that 10 years, there's what is known as the investment period. So you can make new investments from that fund during the investment period. It's usually 3 or 4 years, the first 3 or 4 years of the fund. Then after that point in time, you can only follow on those investments that you've made during the investment period. Now, you probably heard this sort of this notion of is a company sort of venture backable or is it sort of venture investable? One of the reasons is because these investors are investing for a 10-year period. And so the returns, that would justify that length of investment need to be relatively outsized, of course, versus the length of time and the risk. And so, therefore, you probably have heard of this sort of power law distribution of returns within venture funds. They tend to coalesce within the first 1, 2, or 3, sort of top 1, 2, or 3 investments that they're making throughout that period. But understand that most firms run 10-year venture funds. Those venture funds have an investment period. Those venture funds then tend to overlap with each other in terms of them running in parallel, so that at any given point in time, a venture firm should have sufficient capital to be making new investments because they've got Fund 1, Fund 2, Fund 3, Fund 4, for example, all running in parallel, so that at the end of one investment period for one fund, it will dovetail into the next investment period for the next fund, so that they're never out of capital, but they're always looking to return within roughly that 10 or so year time frame.
Yeah, you touched very good, mate. Thank you. And you touched on something there that I was going to bring up. There's this sort of, I don't know what you call it, like a feeling or an expectation or an awareness out there that, if you're going to go down the VC route, you kind of need to be ready for it. Like it's a specific path. It comes with a bunch of pros and cons, and you really do need to weigh up. Now, some of that is taken out of your hands because if you're not growing fast enough, if the market's not big enough, if you're not in the right niche and the right trend, you're not going to get investment anyway. But what do you think, guys? It is about the venture capital path that founders should be aware before they really go and tackle all the pitches and things.
And I think, Jace, to your point before, like I think that emotional energy when you come out of a pitch and someone says it's a no, there's like a million reasons why that might be. It doesn't mean it's a bad business. It doesn't mean it's not a really exciting opportunity. It is just around saying like the fit for purpose of that mandate, that stage, that person. And one
thing that surprised me was like, some investors only do one investment a year. So if you're then going to be upset that they said no to you, I feel like you've got a misrepresentation of the amount of emotional energy. Now, of course, it's very important, and I don't want to belittle that, but you do need to understand the mathematics of the process, I think, to be able to, to get through it in a professional fashion and maintain your energy and perseverance that you need, to go and find that really good match, get that funding you need.
Well, and I think the thing that I'd like to sort of stop us here on is around, like, I think we're actually all talking about sort of a very cookie cutter thing in this context, and that is SaaS, right? And so when you ask, what's your mandate? And it doesn't matter whether or not you're SaaS or hardware or a combination of, the newest Fitbit, whatever. But when you ask, and I think this is something that I learned the hard way, the context of asking about mandate needs to remember that investors are human too, and they may not understand their mandate in the way that you need to be able to digest it, right? And so what I'm trying to say is it doesn't necessarily, like when they say, I've talked to a lot of investment funds that are like, this fund is specifically mandated for climate tech that reduces GHG emissions. And I'm like, have I got a company for you? And then they go, oh, great, except also here are all these other things that we don't like. And these things are in part of our mandate, right? And so it isn't actually asking the question, what's your mandate? You usually only get the vision or the mission part of the mandate. You don't get the deeper part.
I totally agree.
What are the actual criteria you need to, what is your thesis to your mandate is actually sort of really what you're trying to understand. So how do you,
totally agree,
what are the questions I need to answer so that you can believe what I believe and I can make my company match the pattern you're looking for so that you can understand.
I've got a way to tackle that, Olympia, and I coach this a lot. And how I tackle this is, because I totally agree, VCs aren't going to put every little, minute detail on their website. No. But normally in the first meeting and then the second meeting, it's the founder's responsibility, in my opinion, and the investor's responsibility as well. And most of them are, really great people and they don't want to waste people's time and they want to share this detail, is to do that additional matching. That's kind of what the first couple of meetings are for. And what I always say to founders is the mistake they make is they do that in their raise. And you need to do that before you're raising. You need to build these relationships. And I'm not saying you haven't done this. I'm not trying to criticize anyone. I've just seen this done time and time again. When you're raising, you want to have done all this work, this qualification work. Qualification is a very sad word. I don't like, you need to build the relationships, awareness of all these little details. And you want to ask specific questions along the lines of, when we run our round, would you like to participate? And then they'll tell you, and if they say yes, then that's great. That doesn't mean they're going to invest. That means that you've gone through that first phase with some level of success. That's how I would suggest founders can tackle that. It's a complicated process. It's a long process. And Peter said to me the other day, you need 50 to 70 investors in that first process. And that's why it's often talked about as a full-time job, for a founder for several months to get it done. So I don't want to talk too much on this point. Anyone want to elaborate on that?
Yeah, just on that point that Olympia was talking about, and it's such a good point, to ask the investor, what's your thesis on this space? And then you'll have a good sense of how considered the thinking is on the investor's side. And I think it's just as important that you as founders are thinking about, you're interviewing the investor just as much as they are interviewing you. You're going to be with them if they're on the cap table for the next, 5, 6, 7, 8, 9, 10 years. And that's if things go well. So, I remember getting that question, from the folks at Curious Thing well before we talked about an investment with them. They were just like, hey, what is your thesis on conversational AI? How do you actually even think about this space? Unfortunately for us, we had done this sort of internal thematic paper on what we think about the sort of voice interactions. We had done that. So I was like, oh, I'm glad you asked. Here's how we can think about this space. These are the people that we've talked to, and these are the sort of question marks that we have, and these are the things that we're sort of, convinced about. So yeah, it's a good way to sort of test the investor on the other end as well.
Yeah, I think that two-way. Oh, sorry, Olympia.
No, I was just going to say, I think you're right, Jason. You do want to do this pre. And I really, again, I want to like say this out loud as a specific thing. Ooh, I'm going to do it, Paul. I'm going.
Do it.
The venture capital.
Sorry, Gabby, can we pause the recording for just a moment, and then we can have a vote on whether this is okay to keep?
I've got the censor button here. Censor.
The reality of the venture capital model is that they are investing in CEOs that are fundraisers, because they need you to do this process in the way that Jason has described, which means that the CEO isn't technically needs to be more investor focused than it needs to be operational focused. And that can be a very difficult pill to swallow and challenging, particularly like for myself in the hardware space. Like it's such a hard thing to get used to, particularly in the early stages where bringing on sort of higher level management at the cost of operational success was like really difficult. So it's like, do I bring on a COO when I've only raised $1.2 million and my first prototype is going to cost $600,000? Like, how do I make this money last? When I have come to terms with the fact that if I'm going to raise again, the company will need me to either somehow split my time or remove myself operationally from the business for all intents and purposes to focus on this raise, because raising is about continuing to maintain the relationships with investors before, after, and during a raise, not just for a raise, right? So there's this unknown where everyone's like, you start the raise by getting to know investors, and everyone's like, wait, what? And so we get our timing mixed up. So it is about getting to know people, but also recognizing that doing that means that when you structure your orgs and make your org charts, you have to recognize that as your business grows, the role of the CEO will be to be a fundraiser for a certain period of whatever that runway is, because of the pre, post, and during requirements of a raise. And I think calling it out specifically is something that contextually I didn't understand when I first kicked off. And so I didn't do that well. I wasn't as good at it as I potentially have become, because it's not ever expressed in that absolute specificity of that, right? Like, your job is to make sure investors know who you are, understand your business before you have to sell it, not during.
You don't want to get married on the first date. Like, sort of one thing. You kind of got to. There's a whole process that happens before the funding happens, and it is important. And it is very time consuming.
And I think the marriage analogy is a really good one, because to Pete's point, I think the successful venture founder relationships last longer than the average marriage.
Yeah.
So it is a two-way street. And to pick up Olympia's point, like, if you're on the journey of being a venture-backed startup, and it almost certainly means you're raising multiple rounds, and you're actually raising the money for a purpose, and that purpose is to hit certain milestones that see the valuation inflect, go up, so then and earn you the right to not just raise more money, but raise more money at a higher valuation to achieve the next set of milestones. And so it does. That's why we have this whole nomenclature: a seed, a Series A, a Series B, a Series C. It's sort of designed to have multiple rounds of capital. And that, to Olympia's point, is really friggin' hard and really time consuming. And I think one of the great things, Jason, Gabby, that you're doing with this series is trying to make it a little bit more transparent, because it is pretty opaque, but it's never going to be a perfectly transparent situation. The same way as just putting your profile on a dating site doesn't mean you're ready to get married. There's always interactions to be had, and trying to make it clearer and clearer what's going on. But relationship development is really key.
Yeah. I think that one of the things that I thought that this might be interesting to talk about and see how you guys respond. But like, one of the things that I thought about a lot in our seed round through to the Series A, or the first to the second round, was, who are we, right? And so, to Peter's point, like, these people are investing in who you are today and who you're going to become in 10 years' time. And the irony of that is, it's true, but also when they're first looking at you in that first round, like, you don't even really know who you are. You're like a 13-year-old kid who's like, I want to be a firefighter one day. And you may end up being a firefighter. You may end up being,
I used to joke that we were like a baby and we were walking through a briar patch and we were just like, you know, like getting scratched and like losing skin everywhere because in the beginning it's so hard to articulate strongly enough.
Yeah, well, because you don't know yourself very well, right? You've got this, you're really strong on vision and like maybe where you think you're going, but you're not. Like my story from when we first pitched Goterra, which was like, hey, if we put maggots in a box, then we'll be able to manage waste a lot closer to the source, to now we know our story is we are a company that cares deeply about fighting the climate crisis. We do that because we're best at getting robots to make insects do a job. And so now it's not even about waste. It's about how Goterra has created this capability to make insects do jobs with robotics. And it might be waste, it might be this, it might be that. And so each evolution of yourself, the story gets better. But what it means is that when you're starting to do a round and this getting to know you part, how do you get to know someone when you don't really know yourself? And the point of getting to know them is to find out if you're a good fit. And so particularly when you're dealing with stuff that's a little out of the box, like maggots in a box, is not sitting on any kind of, you know, metric or, you know, benchmark that anyone's seen. How do I tell my story well enough so that the get to know me period, I don't get dismissed or written off? Because, you know, like that's the bit that can be quite difficult, because how do I get to know you when I'm not entirely sure I know myself? So
I think the key there is to have great advisors. I'll just really quickly, I would say initially you really want to have advisors that have done this, that can coach you. Sorry, Peter.
Yeah, no, just to say that, you know, I can't speak for all of the investors, but for us, you know, whilst we look at things like market space and, you know, competitive advantage and the financials of the business to whatever extent they're there, and, you know, the terms of the investment and all of the above, it's the founder and team aspect that is far and away the most important thing. So we've come to learn, you know, for good or bad, that, you know, out of all the things that we look at, that probably the weighting around that is probably like 80% of the success of the investment. And so I think the best thing that we can try to do is listen to the founders tell their truth in terms of what they're seeing, why this is important to them, you know, how they're looking to do this, knowing absolutely that all of this is likely going to change over the coming years, maybe not in relation to the what, but certainly in relation to the how. And all of these things will be found out in time. You know, I'm sure you've all heard it before, you know, great teams in, you know, great spaces will find a way. We tend to think about it in that way. And the earlier that we invest, and we mainly invest at Series A and Series B, but the earlier that we invest, you know, the more we spend time on those founder aspects, even more so, and the less tightly held we need to be in terms of, you know, it's got to be this type of product in this space, and that's how it's exactly going to play out. We know actually from day dot that it's not going to play out that way.
How do you know that a founder is a good founder? And I again, based on input, so some of the feedback that I've had is, you know, you're older, and you have children. Like, are they going to get in the way?
No.
How do you don't have a degree in this field? You're not an engineer, so how does a founder give you comfort that they're the right person, aside from a gut feel because they, you know, whatever? Like, what are the things that you're looking for?
So it's okay. This is what we do. So there are a couple of things. We've got our own sort of internal sort of view on key traits that we're looking for. It's a guide. It's not like a, you know, tick box. They have to have this here. But we found that, you know, what is the motivation? What is the deep insight? You know, we found that for our very sort of best founders coming through, there's always some sort of something to prove, some chip on the shoulder, you know. And what we do is we get this assessment done across the entire team. So it's not like the partners form a view and we get every single person. And by the way, founders out there, if you're meeting with like a more junior person within a VC fund, you know, like I'd encourage you to you know, not to treat them as if they're like super junior, because we actually give as much weighting to that assessment from that person within our team as the folks at the partner level. We want as much of a 360-degree view as possible. The other thing that we do is we start to stratify amongst our own portfolio. We've made 33 investments now. Who are the best founders in relation to certain areas that we're looking for? Who are the best founders in our cohort in relation to vision, in relation to team building, in relation to storytelling, in relation to capital raising, right? And so we have this sort of shorthand internally now that we're like, oh, hey, met this great founder. Just to give you a sense of how I think about it, this founder is almost like this person within our portfolio who's great at, team building, for example, or great. So it sort of gives us an internal shorthand on the sort of benchmarking in a way of the traits that we're looking for. Are we right? Look, it's such a subjective area. We try to bring a little bit of qualitative sort of measurement to it, but it's completely incomplete science, and we are totally okay with that. But we try to, at least we measure, we write down, we observe, and we make a call according to those observations.
And so, like, I get that it's an esoterical thing, but like, what are some things that you would encourage founders to do to show that side of them, right? Like, start an argument with you. Yeah,
I'm crazy. Here's a bit of my crazy. Start showing that early.
I think honesty, honesty is what we're fundamentally looking for here. How honest can they be about their observations of themselves, of the business, of where they are, of where they're going? It doesn't have to be, they don't have to be fortune tellers. We're not looking for accuracy. We're looking for honesty. And so, these are the questions that we ask around, what level of sort of self-awareness have they got? Do we feel that they can continue to level up along the way because the journey is different? What's great at Series A? But some of those things you actually have to shed and let go of as you step into Series B when the company's to 200 plus people. So, can we get that sense of them being honest with themselves, honest with us, and leveling up? And I found that with, great founders, they kind of come to us and say, hey, this is what we're doing. And this is honestly where we're at. This is honestly how we think about things and where we think we're going to go. If you're up for this journey, that's great. And if you're not up for this journey, that's totally okay too. It's been great to meet you. And I just feel that type of, almost feel like a casting call. Is there a fit for this, for me and you? No? Okay, great. Next on the founder's side, that sort of confidence coming through, rather than necessarily trying to sell per se in that way.
What do you think, Paul? What's your thoughts on the whole founder piece?
I'm sitting here, and I hope this is helpful, but it's a bit of a sort of an anomaly. But yeah, I think about investing. Like we're an investor in Goterra, and I think we, as a fund, we're an early stage, seed stage fund. So you've got to have that sort of timing of the company fit. And what we say to our investors, and we go back to my comment before about mandate, we really focus on B2B SaaS, AI, and disruptive marketplaces. And then we have this fourth quadrant, which we call emerging frontiers, which is really code for huge problems and founders we fall in love with. And what we don't love is hardware. And what we don't love is solo founders. And then along comes Olympia. And here we are today. And I think we've invested twice or three times in Goterra. And so it sort of talks to a couple of things we've touched on. One is funds have mandates, funds have focus areas, funds have capability, but it is a two-way street. And one of the reasons why you'll see, to your point before, Jace, if you ask someone, will you invest in the next round? And almost all the time, an investor will say yes, because they want the optionality, but they don't necessarily mean it. And time again, I've seen people come back from America in particular, but increasingly in Australia. And I said, I've got interest from Andreessen Horowitz. Said, what do you mean you got interest? I said, well, I asked them if they'd invest in the next round, and they said yes. I said, okay, did you get a term sheet? No. Okay, well, then it was a no. It wasn't a yes. So I sort of reflect on some of these discussions. Again, there is just a magic element to it. And as Pete said, we have a process very similar to what Pete said, very similar in our hierarchy as well. So it's really important we have diversity of perspective. And we've talked in this webinar about how don't take it too personally, but the truth is it's personal.
Yeah.
If you're making an assessment and 80% of your assessment is on the people, then you're assessing people. And if you can think of it more like dating, where there's a spark or there's not, but it's not a random dating, it's structured dating and a directional dating, and saying, here's all the things we're looking for, and they're guidelines. I've got a picture in my head. I want a 5'10" guy with long dark hair and beautiful blue eyes. You can still fall in love with the blonde. It can happen, and so it's an imperfect state. We're not algorithm investors. This is fundamentally human, and I think seeing the potential in people before they see it in themselves is often one of the most challenging, but seriously the most rewarding parts of our job. Because, as Peter sort of said before, we're as an very early stage investor, that you can sort of think of the journey 0 to 1, 1 to 10, 10 to 100, 100 to 1,000, whatever, and that could be customers, revenue, people in the team, offices, whatever it is. That's scaling. And it requires different sets of capabilities, different types of team, different types of leadership. And so we're trying to solve for all this when you're either a 13-year-old or a toddler, as Olympia, right at the beginning. So we're trying to see the potential in people, and we're all going to see that in different ways. And I think it's really important. And one of the things we try and do when we're being pitched is to give our own context and say, like, I've got a PR background, right? I haven't written a line of code in my life, but I've invested and supported technology companies for 25 years. And often I was like, one of the things that I've learned is, as the PR guy, I'm generally the least smart person in the room. So helping really, really smart people tell their story that even I can understand is a bit of a bit of a capability I've developed. But I'm always going to over-index when I'm assessing people on their ability and their potential to tell their story, to scale their team, to grow the sequencing of their business and align that. So I'll over-index on the commercial side, the go-to-market side. So I bring that to the table, and whereas a technical investor with a technical background might be looking much more at the quality of the code and the product vision and the execution on that line. So it is deeply personal. We are all a reflection of our own experience. Gut and intuition are actually products of experience, and we all come at it from a different perspective. So it's one of the reasons, frankly, why we have quite a diverse team, not just in terms of sort of gender or ethnicity, but actually in experience. And how do we look at and how do we make a well-rounded decision on the people that we're investing in? And frankly, it's before that person really knows the answers. So that sort of, it comes back to capability traits and also values, like honesty, as Pete said, that we look at what happens if things go wrong. What happens? How do you deal with the inevitable challenges? Your business model today is not going to be your billion-dollar company business model. When we think about a lot about follow-on investments, we say everyone out there knows all the good news. We also know the bad news, and it's the bad news that's actually the predictor of their success. So for early stage founders on the call, how do we bring that forward? And how do you sort of give the confidence that that's the kind of thing that an investor's looking for? There is no such thing as a perfect pitch, and there's no such thing as a perfect business. And so we want to be able to have
I heard a concept of an ugly slide during the week, Paul, which I thought was kind of interesting, where you show some transparency, right up front, and get that dialogue going early. It can be a bit of a trap for founders to shiny everything up a little bit too much and just be like every other shiny pitch deck. And I think I've heard this a lot from investors over the years, that by opening up, some of these challenges, you end up building a stronger relationship. And so my takeaway from the last section was, relationships are so important. Olympia talked about the time that it takes to build these relationships, but I'm sure you will all understand how critical they are. And it's actually a really enjoyable process, I find. Certainly someone in your founding team or leadership team needs to enjoy this process, because it's going to be ongoing. I'm going to change tack a little bit if people don't mind, I guess, into the nitty gritty a little bit, the term sheet. So a term sheet is something that, these guys have seen 50 or so between them or more. But as a founder, you will have seen none or one or two or three or four if you're, going really well. So I wouldn't mind opening up perhaps to Peter now, just around, how does the term sheet process work? How should a founder think about that term sheet and perhaps the valuation that goes along with it. I think how to value your company, how to talk about valuation and term sheets is a little bit of a dark art, and I'd love to uncover some of that for the people on the call, if that's possible.
Yeah. I mean, we like to keep our term sheets as vanilla or as simple as possible. I think for all the founders dialing in, the book to read, and the book to read for the last more than 10 years has been Venture Deals by Brad Feld and Jason Mendelsohn. Highly recommend that you read that book. It's written from a founder's perspective. It's simple, straightforward, easy, and it will give you a sense of what's important and what's less important. On our side, for our first fund, we actually followed most of the rounds, so we didn't really lead rounds, and so it's the lead investor who negotiates the terms with you for the round. But in our current fund, we've led or co-led I think every single deal that we've invested in. So clear, straightforward, simple, not to have sort of complexity around terms that could replicate into the next round, into future rounds, that would make it difficult, for the team and also for existing shareholders and investors moving forward. I think that's the best advice that I could give. Keep it as simple and as vanilla as possible. I think in Australia, a few of the VC firms I know, maybe Airtree has their sort of open sourced documents around, what a simple term sheet looks like. Use that as a template, as a guideline, Paul. I'm sure from the team at Rampersand, there are already existing templates around.
Peter, quick one. Like, where in the process with Qualgro would a term sheet be? You're maybe leading rounds now. Just say you were leading. Yep. How does the process work leading up to the term sheet coming? For people, some of the people on the call won't have actually been in those meetings and won't sort of understand the mechanics of how it comes and that sort of thing.
We will let you know what we're thinking along the way through. So we might, as we're having conversations, and by the way, it's not a pitch. That's not the way that we work anyway. It's a conversation that is happening. Yes, there might be one presentation, but even on the back of that, there'll be conversations around, okay, can you tell us a little bit more about how you think about go-to-market or, structuring of your, sales and marketing org or whatever it might be. There'll be questions and we sort of go back and forth on some of these questions. In fact, what we tend to do is if we feel that there's something there, we will either have working sessions with the team to see if we can, sort of think through some of these topics together, such as, geographic expansion into Asia or Europe or whatever it might be. Or we tend to get onto WhatsApp and say, hey, look, let's set up a WhatsApp thread. We want to make this asynchronous for you so that you can sort of do this in between times that you're doing some other things, but we're going to put through some questions here. And when you have time in your day, we'd love to get some quick thoughts on some of these questions. And so as we're sort of stepping through that process, we let them know we're considering issuing a term sheet. We'd love to get some more data and color around these things, but I want to let you know that right now, this is how we're thinking about it. And so, we'll ask them, what are your thoughts around valuation? And some teams will have a quite definitive view. It's got to be this, or, there's going to be no investment, or actually I'm trying to get in some signals from other investors and also yourselves. What do you think? And then we'll have, maybe a range view or an approximate view that we can share with them on how we're thinking about it at that point in time. But the term sheet will have, fundamentally, what is the valuation? What is the quantum of the investment that we're looking to make? Any other, sort of rights that we might be requesting, such as a board role or, other types of, reserve matters for the board. And essentially that's the bulk of the term sheet on our end. We try to keep it pretty straightforward and simple. But yeah, if we're thinking of issuing a term sheet, we're in that process, we're pretty transparent with the team and let them know that. And then we continue to have a rolling conversation with them to get to the point where we have enough information so that there is conviction on our side to issue a term sheet. Usually that's somewhere within the first 4 weeks of the discussion, if it's going to happen, typically then.
Amazing information. I'm sure that was very valuable for a lot of people. I was thinking back over some of my experiences and I'm still trying to learn the process as well, just to be honest with everyone. As you don't go through this too many times in your life, and it's always good to have a refresher to help you understand how to run the process in the best way. So thanks, Peter.
Yeah, we do some diligence up front, by the way. We do a little bit of diligence up front. They're the questions that we ask, but also post-term sheet, something for the founders to be aware of. There is typically another level of diligence as well, where we're looking more sort of carefully through things like, various contracts and the sort of diligence that you would need to make before, closing the investment with. And what tends to happen is that diligence will happen in parallel with the drafting of long-form documents, contracts, the subscription agreement for the investment, alongside any changes to the shareholders agreement that need to happen on the back of the investment.
Yeah, I think on average, maybe 95 out of 100 term sheets probably go through to completion. So you really have to probably have effed something up or lied or said something wrong. I don't know what you guys would say as a percentage, but I think the vast majority of term sheets will go through to completion. Olympia, do you have experience on term sheets? Oh, sorry, Paul.
So just to call out a couple of things, like, and I know you probably don't want to dive too much into technicalities, but a couple of things
I think this is really important stuff. Yeah.
So just your point of the 95%, I mean, that started to change last year. And I can say for a fact that Rampersand's never walked away from a term sheet. We are 100% completion. But what we saw last year when the market was going pretty crazy, and you saw particularly later stage, bigger funds coming in, putting down a term sheet, and then doing their diligence. And we saw the completion
because it was so competitive, they were just pegging them down to get like a foot in the door. Yeah.
Massively. And for a founder, it's really important to understand that's a non-binding term sheet.
Yeah.
So one of the questions I think it's worth asking, and I love the way Peter talks about it, we're pretty similar. It's a very collaborative approach. There should never be any surprises, and that's a setup for the future of the relationship, right? It should be, we're in this together. Ask the question, like, how many times do you walk away from a term sheet? It really should be never. But it started to happen. So knowing what that means, because it is non-binding, it's not actually a guaranteed completion. The other bit of the technicalities, I think, is just worth calling out, because I think it's pretty misunderstood. And Pete talked about what goes into a term sheet. We talked about the rights and the reserved matters for the board. And what that means is the investors will have a say in stuff. There will be, now, super early stage companies who are doing safe note first rounds, they might not actually have a board, but there will be things that are limiting and guiding in the founder's ability to run the company 100% as they might want it. So that's one of the reasons why the relationship is so important. I mean, one of the expressions we use, it's not the terms that are the problem, it's the people that are the problem. Sort of got to feel comfortable.
It's like the old joke. My business would be so easy if I didn't have my customers to deal with, or whatever. There's a lot to it. I remember the first time we saw a term sheet, and a few years ago, when we were leading into a round, I got the Airtree one, and I thought, I'm just going to go through all this stuff with my co-founders, because if you've never seen one before and you're reading them all for the first time when you've been issued it from an investor, it is a shock. Trust me, they don't feel good. You've never seen them before. There's all this I've got my own business, and now I have to I don't have so much control anymore. And there's a lot of legal jargon in there. And even though it is being simplified, I would highly recommend, before you run your round, read a term sheet, talk about the terms with people that you trust, because they're there for a reason. Some of them can be negotiated, but you need to understand that when you're taking on third-party investment, there's obligations to those investors. There's things you have to do, and there's some things that you can no longer do without approval, and that's part of the investor,
and get references,
director relationship.
Get references. See how that fund has behaved with those terms. Those terms might look really scary, but
in reality, they can be totally fine, as long as the investor has a good track record and isn't going to use them against you in a punitive way, which can happen. So who you choose is so important.
And is well versed in the life cycle stage as well, because there are certain things that you would have at or not have at seed stage versus Series A versus Series B and onwards. And you don't want an investor applying a much later stage company lens on an early stage company. It's a recipe for disaster.
So true.
As Paul mentioned, reference checks are so important for you as a founder, as you're contemplating which sort of investors you want to work with. Speak to their portfolio companies, speak to folks who they didn't invest in but had conversations with, see if you can find those people, but at the very least speak to the folks who they've invested in.
Olympia, how were your term sheet sort of scenarios on the founder side? How did you find it? What did you learn? Any interesting insights?
I think I'm a little bit more specific now. Like I think the first round I was just like, a term sheet, it's over. And then I was fortunate to have two. And I had to turn one down, which I didn't do well that first time. And then I was oversubscribed that round as well. And sort of saying no was actually harder than I'd actually first.
I found that as well. Like with an oversubscribed round, managing it as a nice person when you've got multiple supporters is actually a super difficult thing to do. Yeah, that was hard.
And now I think, getting to term sheet, somebody asked a question like, how do VCs balance the 80% versus the priority to hit certain milestones? And I think there's this really interesting challenge with like sometimes as a founder you end up in a bit of a tunnel where you're like, I'm running out of my runway's burning like the Tower Bridge and the rest, and I need a term sheet. So now you've got this impetus that sort of ends up driving how you are handling your engagement, because the personal part of this conversation is you cannot divorce yourself from the reality that you built a company and you asked people to come to work for you, and now it is on you to fund that bloody thing so that they can keep coming to work with you. And then on top of that, all of the vision and mission and all that sort of stuff. So I think one of the biggest challenges as a founder in that story is to go and be vulnerable. I think the reason why I'm Rampersand's redheaded stepchild is I was told by
Jim. You read our investor report. Oh, that's good.
Yeah, I saw that deal memo. Is because, and Paul, it might be wrong, but when Jim told me, it was because I was transparent and fairly honest. And now I'm better at how to use that actually as a tool to create interest and be unique, because it's actually one of the things I'm quite good at is being vulnerable. So I'm like, we don't know, this is where we think the risk is, this is what we know, but then I take what I've got a really deep understanding of my industry and how I think about it evolving. And so when you pair that with your personality and what they're assessing you on that criteria, pair it with, look, I understand this. So if you come on this journey with me and you believe what I believe, then I can navigate this, because look at how well I've looked at it. Look at how I understand it. So I may not have all the answers, but I can definitely see where we're going to hit some hard times. And I'm going to demonstrate to you in these relationship conversations that I will tell you that's true in no uncertain terms, so that you can build confidence. And so the answer to the question that's been asked is they don't really. It's your job to make sure that you're selling who you are and whether or not you're the person to take this vision to reality, and whether they can trust that you've got that. And then the rest of it around whether or not the business has the ability to do that, sometimes that's just unfortunately going to be subjective. Some people are really going to get your space, get how you think about it, align with it, believe what you believe, and some just will not. And there's lots of very different reasons for that. Now I get to name drop. The managing partner for General Catalyst, John Kim, said to me, "It's just a game, Olympia, don't take it personally." And I said back, I can't stop taking it personally because it's mine. So I'm playing the game as best I can, but I gave birth to this thing. And so it is innately personal. But what I got from that conversation is it's still a game, whether or not I'm taking it personal or not. This is still a very pattern-driven game that humans are playing. They're playing it seriously. It has
life is a big game. I often think that.
It is all the stuff, but it is still a game. And so if you play it like it's a game and you understand what you want out of it and how you want to kick the goals, you can take control of the game rather than be led by the nose.
Totally. One thing on that, we had the founder of Fingerprint for Success last week talking to a bunch of high growth ventures, and she said that the number one factor for outperformance, getting through your rounds quickly, getting increased valuations and becoming a unicorn, was having a real money focus. And this comes back to what you were saying before, Olympia, about, you know, someone in the company has to have that so that you can resonate with the investors. And I think, you know, someone also has to have that passion and that purpose and that drive. And sometimes they, you know, they cross over. They can both be in the same person, but you can definitely gamify it. It's a big part of the founder journey that we need to learn all these different components, you know, to be able to put our venture together. Now, we have had such a good chat. I haven't covered many of the things that I thought we would, but I think it's so much better. We've dug into some incredibly interesting topics. I think you know, founders have learned some of the most important aspects of you know, how to work with VC, and it's a wonderful tool to be able to fund your company, you know, through to having a huge impact in the world, which is what most founders are trying to do. Let's really quick fire for some of these questions to help the founders out that have taken the time to ask questions. So Fabrizia has asked specifically about InsurTech. I don't know if there's any InsurTech investors here. I don't personally have an opinion, but is there a specific immediate hurdle with InsurTech that either of you guys are able to articulate? And do you have any tips on how to overcome that?
Oh, I think it's an ESVCLP question, Fabrizia, and it's probably a technical answer, so happy to discuss directly. It very much depends on the nature of, you know, whether it's an insurance company, whether it's a tech company.
Gotcha. Is it about the limitations of that type of fund? Okay, gotcha. How do you value a startup that hasn't yet raised funds, particularly in the fintech space? Anyone want to tackle that one? 100 million?
Ask Peter.
I'm so sorry, I didn't mean that.
Yeah, this I think plays into the question of no revenue, you know, and revenue, which is, you know, you find that seed stage valuations are quite local, and so, you know, what we would tend to sort of attribute to a pre-revenue company in Australia is very different from, you know, Singapore versus the US. And so what you want to do is get a sense of, you know, whatever comparables you can with respect to what is being sort of, you know, what is the, you know, dilution, what is the rough valuation of these types of companies, this category of company in this country, and that will, you know, that will give you a sense of it. And, you know, there are some reports out there, I think, you know, from the Australian, I think the Australian VC and PE sort of group. I think they've got a report, and there are various reports that are out there. I think there's one from Cut Through Venture and Folklore as well. That might give you a sense of where the valuations are landing. But yes, the interesting thing is once you get revenue, though, then you at least some level of meaningfulness of revenue, then you have multiples to deal with rather than just a simple sort of non-multiple comparable. And so that's when no revenue can sometimes be better than having revenue, because then you've got those multiples coming into play. So yeah, that's the best way to do it. See if you can find.
I think comparables are definitely the best in the beginning if you can. Try and find out what's going on. So just ask investors and look for reports of be by one there.
I know we're running through really quickly, Jace, but just a couple of quick thoughts that talks also to Peter's, you know, the revenue dilemma. You're raising money for a certain amount of time to hit certain sort of types of milestones. Right? That's how you think about it. And what we're trying to assess in the valuation is, you know, are they the right milestones? Do we believe that they're achievable and ambitious enough, and they're going to deliver the valuation uplift that it needs to be? Or you're getting to cash flow positive, which is very rare. Is it the right amount of money? Right milestones, right amount of money, level of contingency, and then rule of thumb is then for an appropriate amount of dilution. So, you know, let's say rule of thumb, 20% per round. Now, these are very, you know, generalizations are really hard, and you've got to be careful with them, but that's just a starting point. And then they'll flex up and flex down depending on the comps.
From a founder perspective, the earlier the round, the less the dilution. I think it's really, really hard to do. But quite often there's 3 or 4 rounds even before you get to your Series A, and you can really cause yourself a bit of damage there. So I know it's hard.
And just be careful. Investors don't necessarily want the cheapest, right? It's really important. We want alignment, and you can get a really, really good deal that actually screws the company because what that means, the founders get overly diluted. So
you can fix your cap table down the track, but it's something to bear in mind. And keep an eye on your burn ratio. It's not always talked about, and I know some deep tech and hardware, it's not as easy, but if you can keep your burn ratio in that 1 to 2, so that means that for every $1 you're burning, you're adding $1 worth of revenue, or for every $2 you're burning, you're adding $1 worth of revenue. That really helps protect your cap table through those rounds as well. Easier said than done, but definitely something to bear in mind. We've only got 1 more minute. So for those other questions, I've taken a copy of them all, and we're gonna fire back to you answers, Gabby and I. And we do like to finish on time because I know we all have very busy schedules. So I would love to thank our guests today on the panel.
Great.
I think it was wonderful. Appreciate your time helping our community here in Australia in early stage startups. Venture capital is so critical to our ecosystem. We're really grateful for your support. Thanks, Olympia, for joining. Really loved hearing from you as well. And I think that's it from us, Gabby. Hey, over and out or what?
Yes. Thank you so much, guys. Thank you so much. Yeah. Does anyone?
Thank you. I just want to call out one, which is I think everyone's a very anonymous attendee asked, what is a good way to approach VCs for a startup? That's a huge question. Most VCs in Australia have got their emails on their websites. They should do. We Rampersand certainly do on ours. Get in touch directly. But the even better answer is to find someone in the network who can. That's a dangerous answer, but most VCs prefer it. We work very heavily around inclusive and underrepresented founders who don't tend to have those networks. So please get in touch directly.
Amazing. Great tip. Well, thanks everyone. I hope you have an amazing day, and I'll see you on the next event. Thank you, everyone.
Thanks, Gabby. Thanks, Jax. Thanks, everyone.
See you guys. Bye.
Yeah.